All right. So what are some alternatives to down rounds? Well, a down round might be able to be technically avoided at the moment by doing something like a convertible note or a safe financing at a valuation cap that's lower than the prior rounds. The problem is it doesn't really totally avoid a down round scenario. What it does is it pushes off the down round till the point of conversion later on down the road. So, those kinds of interim measures might or might not be really effective. I don't think that they're very effective in convincing, new potential investors that aren't already on your cap table to think that there's no down round going on, to say, oh, well, they're just doing a note round, that's an interim round. You could do a convertible note with no valuation cap that's lower. So in other words, you could do an uncapped note with a higher discount, maybe a higher interest rate to compensate investors for the lower risk. And that truly is an alternative to a down round because you'd only be affecting a price difference at the next round. Now your next round, if it's at a lower valuation, will still cause the note from this round to be treated as a down round later. But that's the only way to truly, I think, avoid this kind of down round feature. You could try other things like doing a new type of price round that has a technically higher price per share today, but maybe has a better conversion feature at exit or if milestones aren't hit. However, I think that sophisticated investors, especially those with legal counsel experience in these kinds of mechanisms, will probably call out what it is if you do something like that. So I think if you're finding that the existing investors just simply will not fund the company without a down round and there are no other options such as debt financing or restructuring of the company's expenses, etc., there aren't that many alternatives, to a down round other than like a vehicle that may end up being a down round in the future. You might be able to do a price round at a flat round to the last round. So you might be able to raise money at the same price per share as in the last round and then do something like warrants or, other kinds of kickers or maybe compromise on governance or voting rights. There are lots of non-economic things that can be done to entice people to invest into a company, but each deal is unique and specific. But a lot of effort that goes into kind of creating a ruse or obfuscating what's actually happening is unlikely to work with anybody experienced. And really, in some cases, it might just end up kind of causing people to say, well, why did this group go through all these mechanisms and machinations to appear as if it's not a down round? That's really only going to help non-sophisticated, non-experienced investors think that it's not a down round, and it might indicate a communication style to other investors that's concerning, which is one of lack of transparency. So I think you want to weigh these different factors and figure out, is it better to just take the medicine and do a down round and the associated rights, or is there some other good reason to do another deal? And I think those are things to think about. If you like our content, I hope you subscribe. I hope you like our video, comment, holler back, follow us on social media. But this is a little bit more information about down rounds in a time and place where down rounds seem to be happening in the year 2023 and 2024. Okay, thanks a lot, guys. Bye.